So good evening, everyone. Today we have Prashant with us. Prashant, is the founder and CIO at CP. He started his career with SBI in 1991 and had a very long stint in HDFC mutual fund and was managing, the Star Fund, which is HDFC Balanced Advantage for over 28 years. Uh, I'm sure is a well-known name in the industry, and we have the privilege of having him with us to give his views on the budget today. Prashant, overall, I think the government has clearly outlined the path for Capex again this time. While managing the fiscal consolidation, so fiscal path, debt to GDP at 55, fiscal deficit target at 4.3, and economic survey, saying that, our real GDP growth will be 7%. So I think overall, I think, infrastructure spend again, they have kind of increased the spending this year. Cloud services, defense, focus areas, little bit of noise around STT, which has taken kind of, markets negatively. But all of us are here to view your, hear your views, on the market. Uh, one request, I think, apart from market, given the way gold and silver have moved, maybe some view on that over the last couple of days. And to the participants, any questions, please, put it in the chat box, so that we can take it up, after the Prashant's presentation. Over to you, Prashant.
So thank you, Ritesh. Good afternoon, everyone. It's a pleasure speaking with you. Uh, I don't want to be influenced by what happened in the markets to comment on the budget. I think overall it was a great budget. There was no hype and it was extremely rich in substance. It has maintained continuity of policies of taxation. So net, I don't think there is anything to really worry about this budget. The underlying assumptions of nominal GDP growth, of revenue growth, of expenses are all extremely realistic. I think the markets and people like you and me are now coming to terms that India is a lower inflation country, and even a 6 or a 7% real growth is translating onto only to a 10-11% nominal GDP growth, and that is reflecting in the assumptions of tax revenue growth itself. And if corporate taxes are budgeted to grow around 11% or 12%, it tells us very clearly what is the long-term growth rate of corporate profits and of markets likely to be. There is a good country, a mature economy needs stability in taxation and policies, and this budget delivers on that yet again. There are very few taxes that have been changed. Basically, the buyback rules have been changed to make buybacks more friendly, more acceptable, which is great for capital allocation by companies. And the STT rates on F&O have been increased. This again, I think, is following a pattern where the government is trying to curb speculative tendencies, because the majority of investors or participants in this type of trading, they end up losing money. The data is very clear. So I think Dream 11 was discontinued. Then this STTs, the weekly settlement was done away with, and now this has been enhanced. So I think if you look at all these actions, they are clearly fitting a pattern. The government says that retail investors should be extremely cautious when participating in these, and government wants to promote longer term investments. I think the third highlight of the budget is the continued focus on improving the ease of doing business, on simplification of taxes, on simplification the way taxes are administered, on improving the ease of doing business in the country. So there are a lot that has been done outside the budget. and this budget continues to take that process forward. The new direct tax code is likely to become effective in few months, and it is supposed to have extremely simple forms. The GST was simplified. New labor tax code has simplified things. A committee has been formed to look at how to simplify things, not just at the center, but even at the state level. A lot of simplifications in the custom duties also have taken place. India is slowly beginning to replace, it is decriminalizing non-compliance with lot of laws and is replacing these with penalties instead, which is a great thing. So I think there is clearly that focus is intense and relentless. It's a long journey of improving ease of doing business, and this budget takes us firmly on that path. This budget, while continuing to focus on manufacturing, it also brings a renewed focus on services. So a lot has been done to India is has a large number of young people. We need to create large number of jobs. Services are far more labor intensive than manufacturing, especially with automation. So right from simplifying things for IT service companies, GCCs, by way of making it simpler for safe harbor provisions of lowering the implied or margins in these companies for transfer pricing. There is also intense focus on promoting skills in a variety of areas. So government wants to improve skill levels in the areas of health. They want to, tourism is a big focus area. They want to train guides in some iconic sites. So if you read the budget document, it is fairly clear that a lot of attention is being given to areas that are service intensive, employment intensive, so which can promote jobs. I think in net this budget there is. I am extremely happy with this budget, and this is what budget should be. Budget should over time become less and less relevant. They are basically essentially a scorecard for the government's income and expenditure. And if you observe, government has been taking a lot of policy decisions outside the budget as well. For example, few weeks back, taxes on tobacco were increased. So I think reforms, changes are an ongoing process, and I think this budget, therefore, has not. There are no big bang announcements. The big changes in India have taken place, and that is actually extremely good news. I think the reaction of the markets to this budget was negative, not because there was anything negative in the budget, but expectations were running pretty high, and I would say they were unrealistic. Just because markets have fallen and just because foreigners have been sellers in the markets, it is unreasonable to expect the government to do something to reverse the gains in the downward trend in capital markets, or to reverse the trend of outflows by foreign portfolio investors. I think India is a fairly strong country. There is stability in all macroeconomic parameters. So I don't think the government uh, was needed to or should have acted in a knee-jerk reaction. I think whatever they have done is correct stability in taxation and offering no concessions to get short-term capital flows. In fact, there is no need. As far as the markets are concerned, I feel, as we have been highlighting, that markets have been range bound now for almost 15 to 18 months. I am referring to Nifty, the large caps. This reasonable time correction has taken out some of the excesses in valuations of large caps, and markets currently are fairly reasonably valued as far as large caps are concerned. On the other hand, small and mid caps, as we have been highlighting for some time, they continue to be uh, less attractive. And despite the significant or material price correction that some of these spaces have seen, we think the risk reward continues to be in favor of the large caps. The There are a lot of concerns around continued FII selling. In my opinion, foreign selling has been intense in India. In fact, this is one of the longest periods of back-to-back selling for I think 16 or 18 months. A cumulative of almost $40 billion of outflows have taken place in this time frame. I think the reasons for this selling are that if you go back 18 months, the markets were quite expensive. India's premium over emerging markets was extremely high compared to longer term averages. So that clearly was one reason. The second reason was that earnings expectations in India were running ahead of reality. They were very unrealistic. So we have seen some earnings downgrades in last 1 year, 18 months also. Today, the earnings are now aligned with the nominal GDP growth rate. So I think current earnings estimates are realistic. But nevertheless, elevated earnings expectations were the second reason why foreigners have sold down. And I think the third and very important reason was that globally, if you see, these markets have been driven by narratives like AI, semiconductor, etc. Now, these are areas in which India does not have any place. So I would say money has not moved out of India into other markets only. It has rather moved out of into these new narratives where India has no place. And therefore, money has gone to Korea, Taiwan, Japan, US, wherever these narratives link plays are there. Currently, the foreign ownership of India is nearly at an all-time low. While it is hard to say why, when will foreigner flows revive, but I think one, it is less relevant for India today, the direction of foreign flows. Markets have been range bound despite such intense selling. What does that tell us? It tells us that the flow of local money into markets is so strong, it is many times that of the foreign inflow or outflow, and therefore the volatility of markets has gone down structurally. The impact of foreign flows on the markets has moderated considerably. So, to that extent, I think the sensitivity of investors towards flows should be less. On the plus side, I think now India's premiums over EMs have reverted to longer term averages. Our multiples are reasonable, earnings expectations are reasonable, and currency has seen a very sharp depreciation against the dollar and the euro. It has been seen in the past that after sharp depreciations of the currency, foreign flows tend to pick up. Now, you may ask a question, why has the currency depreciated so strongly if current account deficit continues to remain quite low? So, what has happened in India is that since Indian markets were pretty expensive, especially in the small mid cap space, especially the MNCs were very expensive, and the themes like manufacturing, etc., they were very expensive. So, in these spaces, we have seen a lot of outbound FDI. So many companies like Hyundai, LG have listed, BAT, GE, ZF, Whirlpool. They have sold stakes in their Indian arms. These have seen large number of exits, and all of these, when money goes out, when the foreign companies or PEs sell, this capital goes out of the country, and therefore the net FDI into India has been extremely low for last 2 years. And that is one of the key reasons why the currency has depreciated. Presently, the real effective exchange rate of rupee, as per RBI, is showing significant undervaluation. I think with the weakness in markets, with the weakness in the multiples of these narrative-driven themes, with the reluctance of the markets now to buy into IPOs or issuances, it is interesting to note that almost 55% of issuances over last sorry, IPOs over last 18 months are now in the red. So the appetite for those issues has gone down. I think in these market conditions, the outbound FDI in India will be sharply lower in the current year, and therefore it is possible that the rupee may stabilize or even mean revert. Sorry, the rupee may mean revert. We have seen in the past also that after a sharp depreciation of the rupee, the next few years either it does not depreciate or depreciation is extremely small. And even when that happens, I think this will also be supportive of the foreign flows. Coming to the markets, I think these markets offer much better risk reward in large caps compared to the past. These markets have held their ground. They've been range bound despite significant foreign selling. I think new issuances, as appetite has gone down, they will suck in less amount of money and more flows of local mutual funds, local institutions will get into secondary markets. And I think the momentum in small mid caps has been broken. So over time, it is reasonable to expect an increased allocation towards large caps. So I would say this is a market which is good for accumulation. That we, if you have a 3 5 year view, if your return expectations are realistic, low double digits, I think this is a very good time to be accumulating India because we are moving absolutely in the right direction as a country, as a nation. So let me stop here and I'm happy to answer any questions or clarifications that are there. Thank you.
Uh, Thank you, Prashant, and this is always insightful. And some points which you already touch upon, but I thought there are some questions around it. One, Prashant, see, government increased their capex, right? Capex budget this year is at 12.2. This is a healthy increase over the last year, and there has been a specific, emphasis on EMS. The fact is that talking about the entire semiconductor, some railways, there are some, specific talk about the data centers. How do you see these things, and especially do you think that these particular any of these area provides a good alpha opportunity over a period of next year or two?
So, but one see, while capex is up 12% over the uh, revised estimate of last year. Over the budget estimate, it is up, I think, much lower because the
Yeah.
actual expenditure last year was lower than the initial budget estimate. So if you take a 2 year view, fiscal 26 and 27, the total increase is 16%, so which is roughly 8% per annum increase.
Right.
So our view has been that government's uh, allocation to capex in percentage of GDP terms is unlikely to move up. So I think this is happening. This is in line with that view. Uh, you are right that the capex towards defense has gone up slightly. The railways have seen a meaningful allocation. Allocation toward roads is less. And yes, the one unique thing in this budget is that the government is bringing a lot of focus. So they have identified 7 areas where India can scale up and it needs support. If you look at the PLI scheme, there is no mention of the PLI scheme being renewed in mobiles in assembly. We are now moving backwards to the components stage. So I think this is a very thoughtful government, and they are promoting, incentivizing, subsidizing, giving support to areas where you need to kickstart investments. And once you have done that, you move away from that space. I think to invest on the basis of these policy decisions would be erroneous. See, whatever is announced is known to the market, all of it, and therefore it tends to get priced in. I think if you look at some of the areas where investors have been upset or not happy with the outcomes, these were mostly narrative driven sectors. So when you catch a buzzword like RE, renewable energy, EV, Make in India, a few years back, chemicals was a theme. So wherever there is some excitement, some promise of growth, people tend to move in there. I think that is not the right way to invest because what is known to you is known to everyone, and these growths are typically priced in today. And over time, if the growth is delayed or is slower than what was priced in into initial expectations, then suddenly you feel the outcomes are not good. So I would suggest that government is supporting those areas which are very raw, which are nascent, which need lot of uh, investments, and these the time frame over which these investments will start producing results are fairly elongated. So I would not, these are more relevant for the country that we are moving in the right direction in manufacturing for sustaining higher growth, for creating employment, for reducing India's current account deficit. But I would not venture to say that these are investable themes. Yes.
So because they spoke about specifically the data centers and the cloud infrastructure, and also at the same time there was no mention about the energy and power, which is also an important part of it. So do you think that it will be difficult to find a theme in it, or it's still required more development and clarity in terms of emerging theme for us to play?
But a data center is a good opportunity for India. Why? Because we have lots of land, right? We have our solar energy rates are one of the cheapest. It's the most competitive in the world. And we all our manpower costs are also low. And when you build a data center, it will create a lot of jobs. To run a data center, you may not need too many jobs, but to build data centers, you need lots of equipment, air conditioning, power, civil, all of that. Whereas a large part of the hardware is imported, which does not create jobs, but it is a great activity, economic activity. These are typically very low ROC projects, the data centers. If you look globally, they are extremely low ROC. So I would be very cautious when we are, as secondary market investors, we participate in these. We have to be very realistic that what valuations we are buying these and what are the long-term outcomes. But by giving this tax break, I think government is making India a lot more competitive. Because of AI and because of data localization laws, the opportunity for India to attract this Capex is extremely large. And therefore, I think once again, think of it from a country's perspective and data centers. I think I would be very cautious, very observant while investing. But you are right, power demand can certainly grow. I think power demand may grow by half 1% extra because of data centers over time. But that again is not enough to move the needle, or you simply go and buy the power stocks. But yes, I think overall it is positive for solar energy, for the power sector, for capex, for job creation, for bringing more large companies. They're increasing their commitments to India. Yes.
Uh, Sir, on the same line, there any sectors specifically which you believe we can take away as a positive or negative? Means there's some sectors where there was a expectation which has not been met, or some sectors where we think that this budget makes a case for relook at those sectors which might not be, on the radar.
So, but I think one sector which could possibly benefit on the margin is IT. So IT sector has massively underperformed because the narrative has been that AI will kill this sector. So time will tell whether that view is right or wrong. Our view is that as enterprises, which are the customers of these IT companies, as they adopt AI, the IT spends will go up and not lower. AI adoption in delivery of services by the service companies will reduce the effort will increase the productivity, but what money is saved, we think will get spent by the customers on other areas. The IT spends are not coming down. So because of this fear, I think this sector has fallen, it has underperformed. And I think in this budget, the uh, change in tax laws around buybacks should impact this sector positively. Because now, if I tender my shares in a buyback as long-term capital gains, I think it makes it more economical for these companies to do buybacks as against giving dividends. Many of these companies, their payout ratios are 80-90%. So I think if valuations remain reasonable, we could expect more buybacks, which would be supportive of valuations. However, we should be mindful that there are no, in my opinion, multi-bagger opportunities in these markets. These are fully discovered markets. Small mid caps are expensive. There is no deeply undervalued sector in even in large caps. So IT sector, we think it should continue to grow, but we know it's a very large sector, $200 billion sector. The growth rates are unlikely to be beyond mid single digits in dollar terms. So our return expectations again have to be commensurate with that view. Yes.
So you touched upon FI sentiment and the fact of that FIs have been a net outflow. Uh, uh, there was some discussion saying, is it the STT change and all will be a dampener. At the same time, PROI, where they have increased the limit from 5% to 10% for individual and on aggregate basis from 10 to 24%. Combining the together, do you expect some incremental flow coming from the FIs now? Because at least those individuals who had a constraint will not have that constraint. And now this scheme has been extended beyond NRI to even foreign residents also.
So, Bharat, I think it can have some impact over the medium term. See, these are not things which can lead to any impact overnight. For someone to start buying into India and to make a meaningful impact on a $5 trillion market cap will clearly take time. These are small steps which should have some impact over time. But clearly, these are not meaningful to impact anything in the short term. See, I believe that it is good for a country to get money on reasonable terms. If you uh, and see, you cannot keep on subsidizing or giving incentives or tax breaks here and there. You need to have moderate levels of taxation. You need to become attractive from your growth perspective, from your policies, processes perspective. And I think government is doing everything right. And see, foreign flows, there are many variables that go into that. So currency is one, EMs is another, US tech is third. I mean, there are so many. So just by offering you some tax break, it does not mean that money will come. And even if it comes this year, if markets go up, it may again go out next year. So it is not solving any problem. I don't think government should take any knee-jerk reactions. And see, markets which have not done well for 1 year, which have not done, it is not creating any crisis in the country. It is good for a country not to rely on portfolio flows to fund its current account deficit. We used to do that in the past and we were extremely vulnerable. If you are funding current account deficit through portfolio flows, it is only postponing the problem because when flows go out, then what do? Your currency is also under steep pressure. So I think our country is extremely small, our current account deficit is low, our foreign exchange reserves are reasonable. We should focus on getting FDI into the country. And government is doing everything possible to do that. If you look at last few months, in 5 or 6 financial institutions, big FDI flows have come in. Whether it was Yes Bank, Shriram Transport, Federal Bank, or a few more. Government has budgeted a large amount in the divestment. Maybe it is looking at IDBI. So again, that will be big ticket FDI into the country. So And see, there is one more perspective to this. The capital raised or the supply of stock in the market last 1 year was 5 lakh crores between OFS, IPOs, QIPs, whatever, promoter sell downs, PE sell downs, 5 lakh crores. If you bring in 50,000 crores of FI selling, this 5 lakh crore supply becomes 5.5 lakh crores. So it is only a 10% impact. So the biggest reason why markets have not done well, apart from valuations from a demand supply perspective, has been the very large supply of capital. And I think that is where the bigger change is taking place. If 55 or 60% of the issuers are underwater, that market's willingness to buy into these new companies is sharply reduced. And I think that is it will have a much far more positive impact on markets than maybe any reversal of FI flows. Because if I don't want to buy, if fund managers say secondary markets are offering me better value than primary markets, then so much money will go there. So look upon FI selling or buying in the overall context of the supply of money or supply of stock from primary. Look upon FI as one more source of supply, it is 10%. So I think net, while it is very hard to forecast the direction of FI flows, Indian markets depend a lot less on foreign flows, but it is safe to say that if and when they stop, these markets should move up. So I would say that we should use this period of foreign selling to accumulate stocks. And this is what I used to say earlier in my career, that the best opportunities to buy Indian stocks are when foreigners are selling. In the past, with this amount of selling, markets would be down 10-20%. So now that kind of an opportunity is unlikely. But flat markets for 18 months is a reasonably good opportunity in itself. Yes.
Sir, one and there are multiple questions on that on the chat. Basically, it's saying that how long do you see this consolidation correction? Now, on the face of it, markets have consolidated, but there is a lot of pain in the mid caps and small cap. So, how do you see how long do you see this, and is this time to increase allocation to mid cap and small cap? That's a one question, or maybe even through systematically building the portfolio through SIPs or through building it as a slow, gradual approach to it.
So, Bharat, I think this whole thing about small mid caps, to my mind, in my opinion, is misunderstood. See, small caps are much larger in number. And when you have a much larger sample set, and many of these companies are new, less mature, then the best companies, 2%, 5% of these companies can indeed deliver outlier returns. And these are what dominate our memory. We recall the big winners, but we don't very few have the ability or are lucky to identify the big winners in advance. We realize this only by hindsight. So what makes more sense instead is to look at average outcomes. So how do small caps as a category do? How do mid caps as a category do? How do large caps do? And if you look at the performance of these indices, there is no trend or there is no data that says that small caps, mid caps sustainably outperform large caps as a category. There are periods of outperformance and periods of underperformance. What has been seen is that in a crisis, when markets fall sharply, if large caps fall 20-30%, the small mid caps fall 40-60-80%. And from that extremely low base, as capital markets normalize, the returns are much higher. And this is what has happened in this space last 5 years. Today, there are, I think, roughly 13-14 crore unique demat accounts. Of that, I think 11, 8, 10, 11 crores have joined the markets after COVID. So these people, 8 out of 10 investors have no history of capital markets prior to COVID. And they have experienced much higher returns in small mid caps because they fell 70-80%. If 30 goes to 100, it is 3x. If 70 goes to 100, it is 40% return. So I think it would be wrong to extrapolate that as a category. We have been saying this for 2 years now. And I would once again reiterate that that it is wrong to expect small mid caps to outperform large caps. Just because they have fallen 30-40% does not mean they are attractive. Maybe they were terribly overvalued 2 years back, and maybe they are still overvalued or fairly valued. So I think, but having said that, small mid caps with this correction, they are beginning to offer some opportunity for a very knowledgeable long-term investor. So there will be opportunities to do individual stock picking 1 in 10, 1 in 20 companies. I don't think there are multi-baggers, but there can be reasonable investment opportunities. So I would say this is a market which is in that phase, but I would still say many companies, in fact, I would say majority of companies are still not offering value in the small mid cap space. If you are investing in a fund, the fund manager has a very good track record. I think SIP you can continue, you can start, but your exposure to small mid caps always has to be very carefully thought of. Yes.
Sir, nowadays it's very difficult to have a call on investment and don't talk about gold and silver. So there are multiple questions on gold and silver. You have any specific view or a thought on that?
So Bharat, you know me well. Ritesh knows me extremely well. I mean, I know only listed Indian equities, and to some extent, I understand bonds. So I have never invested, never studied gold and silver. However, I can explain a bit what is going on, and these are very basic thoughts. Please don't take them seriously. I think once US impounded Russian reserves, the US has probably, the dollar is losing confidence slowly. And you can see that the share of global reserves in dollar terms is declining and gold is going up. So gold is being bought, is moving into very strong hands, which is the central banks of the world. And when you say, I want Greenland, this again, I mean, does not help restore confidence into the dollar of Europeans, who are one of the largest holders of US treasuries. So I think the Deutsche Bank's chief said that uh, Europe has Greenland and it has $8 trillion worth of European or US treasuries. So I think this is why dollar has done so well. If you look at any parameter in terms of purchasing power of gold, it seems to be overvalued. But this is a geopolitical shift when very large, very long-term balance sheets are moving into gold, and it is hard to say what will happen to gold over long periods. However, compared to silver, which is moving into weak hands, so silver has been driven, to my mind, probably more by retail flows, which are weak hands, trade getting into momentum. Momentum is influencing that. Gold, on the other hand, I think will continue to find buyers at every fall, and central banks would look to allocate more towards gold. So I have seen one more thing which we have said, experienced time and again, that the majority opinion in investing is almost always wrong. I have not come across a case where the majority opinion has been right. And the majority chasing gold and silver was a very clear indication that the long-term outcomes will not be appealing. This is what happened in SMIDs, small mid caps. This is what happened in, if you, it happened to technology in 2000, it happened to infra in 2007. So the majority opinion in equities in investing is wrong. So I would be cautious on these spaces without knowing anything. Gold, I think I always said a 5-10% allocation towards gold is always good. Gold will do extremely well in a crisis. It is a great insurance to have, but as a short-term investment, I would not recommend either gold or silver, and certainly not silver. It is far more volatile. And while there are industrial uses of silver, there are also a lot of personal uses of silver. It is used in many religious ceremonies. It is used in weddings to make jewelry, to make utensils. Those that demand can collapse, right? You apply work on sweets, that demand can disappear. And even in industrial use, wherever there is a commodity sees massive price inflation, the industry works doubly hard to either reduce the consumption or to find substitutes. And over time, I think when a commodity becomes very expensive, which is industrial or personal use, there is always a risk. And these cycles are very long term. When gold underperforms, it can underperform for 20, 30 years. So I would say I would be fairly cautious on these two spaces. Gold I can still keep as a very long term core asset allocation, but not as a short term bet. Yes.
On the same line, you mentioned about the the bubbles burst, and AI is another place, right? So how do you see AI, and how do you see, in case you think that is also going to go through that same experience of consensus buy, to the fact is that it's now overbought. And if that correction happened, do you see, we don't have large exposure in India, so not that we'll have a direct exposure to India, but do you see anything happening there, and maybe some impact of that to our country, maybe positively or negatively?
If it happens, see, I mean, to a very casual eye, to one who does not has not seen it in deep, I don't understand it well. But when you look at the investments going in and the revenue models, there seems to be a clear mismatch between the two. So over time, probably it will disappoint. When it disappoints, it can be very good for India. I said that globally, money has moved into the narratives of AI and semicon, and India has lost out because of that, because we don't have plays on these narratives. So if and when this narrative unwinds, I think you will get money back into India. But until such time it happens, one will have to be patient for foreign flows to come back. Last 2 days, there were flows that could be just pre-budget, excitement, short covering, I don't know. But I would expect that over time, the outflows of foreign money from India should taper down because valuations are reasonable, currency is down, they are underweight India. Yes.
Sir, I know the time constraint. One of the another important point, which is the entire spike in the long end bond yield across the globe, specifically JPY, where guys are now worried about the unwinding. I think one event happened when first time when there was a spike, and we have seen some major global correction, but now we have seen across the board spike in the long term yields, especially JPY, where the unwinds are happening, and which effectively for globally the cost of capital and everything is increasing, including this entire unleveraging. How do you see this entire global macro setup impacting?
It is the single biggest risk facing all asset classes, all capital markets across the world, and we have been highlighting this in every single presentation communication that the elephant in the room is the US yields. So governments across the world are either unwilling or unable to curtail fiscal deficits. Debt to GDP of various countries is going up, especially of the developed world. And the willingness of the world to buy increasing amounts of US debt is constrained. That's why gold is doing so well. And in Japan, inflation is back, growth is back. So I think this is the single biggest risk, and I don't think I have an answer, but this is clearly a live issue. I think India is well placed as an economy. If you look at India's current account deficit, it is extremely low. It is very manageable. So we are unlikely to face a challenge of funding it. It is so low. And government is doing everything possible to promote manufacturing, to curtail imports, to over time replace petrol, diesel with ice, etc. So I think India as an economy is unlikely to suffer should global yields go up even, I mean, materially. However, capital markets are subject to, these events. If US 10-year yields spike up, if Japanese yields spike up, it could lead to one more renewed bout of selling by foreigners. It will not impact profits of Indian companies. It may not even impact materially India's cost of capital because, or maybe 25 basis points here and there, which is manageable. But markets can come off. So if you look at 2001, 2008, 2013, 2020, global developments, 9/11, Lehman, tapering, COVID, markets fell very sharply. So should that happen, this would be a great opportunity to top up, and these possibilities can never be ruled out. It is a live issue as we speak. Yes.
Thank you, sir. And for anybody where we are not able to take your questions, please reach out to your relationship managers. They will, put that thing together. We'll get those answered from Prashant and share back with you. Hand it over to Ritesh for his closing remark.
Thank you very much, Prashant, for the insights. I'm sure clients also have got some comfort and so got some insights on the budget and the way forward on the markets from you. And thank you everyone for spending the evening with us. Looking forward for next time. Thank you.